How do we warm up to bonds and debt near the zero bound or beneath the zero bound? How do we sustain our interest in these low coupons?
Well, I think we don't. I think, I mean, look, you obviously always need some safe government bond in any portfolio, but the notion that they're going to play as big a role as they did in the past when rates were much higher and you had both yield and protection, that idea is fanciful. And in the future, it's very clear that you're going to need to look elsewhere for both yield and for resilience. And that's what we're seeing global investors, large asset owners doing. They're moving away from the traditional safe havens into illiquids, into alternatives, into Chinese bonds, which are perhaps the only ones yielding, meaningful rates.
I mean, I don't know whether you do go into Chinese bonds, Isabelle, but where do you find yield?
Well, that's exactly the tough question that a lot of asset owners are grappling with. It's very easy where you find yield. You find it in high yield bonds, you find it in emerging markets, and you find it in China, which obviously is an emerging market. But for a lot of asset owners, these are investments that they would never have contemplated historically because of their risk parameters. And likewise, for a number of them now contemplate investments in illiquid assets. These were things that they would have thought were completely off limits in the past, and now they have to be on the table, or even equities for income, focusing on dividend yielders. Portfolio construction is being completely, taken back to the drawing board because people understand we're going to face these low interest rates for a long, long time into the future.